Hi, everyone. Thanks for joining us again for our fourth quarter investment update. I'm John LaBarca, Director of Investments at Vision Capital. First, let's review the third quarter. Markets continued their recent rally this quarter. The S&P 500 gained 7% and reached another record high. It's now up 15% this year despite the drop we saw in the spring. Small cap stocks had their best quarter of 2025 and led stocks gaining 9% in the quarter. International stocks continue to outperform the U.S., with the developed market index now up 26% this year. Bonds were also up again in the third quarter, rising 2%. They're now up 6% this year and are on track for the best year since 2020. Expectations for more interest rate cuts from the Fed drove markets in Q3. We can see these expectations for rate cuts in this chart of the one-year Treasury yield, which decreased during the quarter following weaker jobs reports and the Fed's recent policy meeting. The Fed has shifted its focus from fighting elevated inflation to the slowing employment trends to support the economy. Monthly hiring has slowed to close to zero in recent months since the spring tariff policy rollout. Many employers are citing uncertainty in the outlook. Federal government hiring has stopped. New AI technology and task automation may also be weighing on hiring plans. Despite the soft job creation, unemployment remains very low, near 4%, despite creeping up a bit from the lows of 2023, which were below 4%. Despite the softer employment situation, inflation reaccelerated in the third quarter. Core PCE reached 2.9% year over year in August, compared to 2.6% back in April. Some of the increase appears tariff-related in the goods part of the economy. The response to this easier monetary scenario has been asset inflation, as we can see here with our AI-generated image. Investors have come to believe that the Fed will allow 3% inflation if the alternative is a slowing economy and potential for job losses. Have we lost the 2% inflation target mandate? The Fed says no, but its actions suggest yes. Some have begun to question if the Fed will lose its independence. The result is that the vast majority of financial assets are appreciating at the same time. Gold, silver, most commodities, cryptocurrencies, stocks all over the world, and housing prices. It's not a coincidence to us that they are all moving higher in unison. But what about elevated stock valuations? Our outlook remains positive on risk assets in this environment despite the valuations. Interest rate cuts, tax burdens moving lower in a few months, the continued surge in technology investment, onshoring, and deregulation should all support the economy in 2026. Hiring may also improve as we move further from tariff announcements. Fed interest rate cuts against the backdrop of a still strong economy are historically positive for assets. The combination of fiscal and monetary stimulus at the same time is rarely seen outside of recessions. It's been powerful to have that occur at a time when the economy continues to grow at 3% or more. So in summary, let's turn to our outlook. The economy should be helped by several factors, including Fed rate cuts, the fiscal impulse of the recent bill through tax cuts and spending increases, onshoring and foreign direct investment in response to tariff policies, and productivity gains from the AI revolution. Offsetting that will be some downward pressure from the tariff policy, as we may see some hit to corporate profit margins and weaker personal consumption. The AI revolution may also lead to jobs being eliminated faster than the workforce can be retrained. The balance of these factors should be slightly positive, and we expect economic growth to continue into 2026. We added to stock portfolios in the spring when U.S. stocks fell significantly, and we've maintained that increased exposure during the recent rally. We've also maintained our higher allocation to gold even after its surge over the last year. We continue to favor shorter-term bonds for our fixed income holdings, as rates there are still attractive and bring less risk from fiscal deficit concerns. Thanks for joining us for our investment update. We look forward to connecting with you again soon.